Hey everyone, my name's Andy. I'm with the Finding Value Finance YouTube channel. I've got Scott with me today. I actually saw him on Twitter. I'm just going to show you kind of what his Twitter looks like. It's right there. Uranium, his handle is @U_AG_. I didn't want to say that because it's a hard one to actually remember and say. So I wanted everyone to see it. So if you want to add him on. He's got a lot of really good content about uranium. I was looking at his Twitter and found all this great information about how he correlated stock prices and interest rates. And that's exactly what I think is the case. He correlated it and showed it. And I was like, oh, that's really smart. That's a cool thing. And I wanted to talk to him because he has all this good information about uranium and commodities and all that stuff. So I really wanted to get him on the channel, get his opinion on how he views this next commodity bull market. So thanks for coming on the channel, Scott. I really appreciate it. It's a pleasure to have you on here, and thank you for taking the time.
Thank you, Andy.
So
no, thanks, Andy. No,
one question I have for you, Scott, is what was it like the last commodity bull market? Because I know we're roughly the same age. Like what did you see? What did you notice? How long have you been investing? Kind of like what's your background?
Yeah, no, commodity boom last time around was epic, right? That's probably the only word I can use to describe it, epic. So I started investing when I was 18. So back in 2004, I think I was fresh out of high school and first year uni. And yeah, someone that I really respect just said, go for it, start investing now. Like, even if you lose money, you'll get something out of it and it will be a good tuition fee. So I just opened up a brokerage account and just started investing. Now, I had no idea what to look for. So the first one that I started investing was like oil stocks and zinc stocks and your typical BHP, Rio Tinto and so on. And then actually I came across Peter Schiff. I don't know if you ever came across Peter Schiff, but yeah, I came across Peter Schiff. There was a good friend of mine who had also started investing with me around the same time. He's a full trader now, but he said, have you checked out this guy called Peter Schiff? So I checked out Peter Schiff and I was pretty sold on the messages that he was kind of delivering at the time. And so I started investing in gold stocks and things like that. So 2004, 2008, I think, from there, I didn't make too much money because obviously my capital was quite small, but I think my total return over the 3 years that I invested in, I think was around 4x, 3 to 4x. But I was so hooked, I was just trading in and out, like very frequent trading. And obviously I did well just because all the commodity stocks were going up. But when I look back on some of the purchases that I made, it was crazy because if I hadn't sold, if I just sat tight, I would have done 50x, 100x, or at least a minimum 10x. So yeah, that was a big lesson for me then. So, and then as you know, Peter Schiff once again warned about the housing market and subprime mortgages and things like that. So I was quite lucky enough to convince my dad to get out of the stock market just before it crashed. And then as it was falling pretty hard, I think it was sometime in 2008, I came across silver story through Mike Maloney and his ratio comparison. And that's how my ratio thing started, from Mike Maloney's original videos. And I got into silver and these stocks are just like going up every day. I think I was, my dad's overseas right now, but I was with him at the time when it was going up like crazy. And every morning I would just wake up laughing out loud with my dad. And we were just like, this is crazy, and thought it would last forever. But little did I know that, commodities and the mining companies are very cyclical. So he was lucky that he got out. He sold some of them at the top and got into land, and they also went up in value. But we wrote a lot of that down. So I think that the two key lessons for me from the commodity cycle was sit tight. You've got to just sit tight. Don't try to play cute and hold on to your stocks and just ride it through, because your gains are going to far exceed your expectations. Your valuation of these mining companies will just be insane in the commodity bull cycle. So that's lesson number one. And understand that when everything's so hyped up and when you look at the ratio and they are becoming overvalued against history, or near its all-time high against history, then you've got to start thinking about getting out. So yeah, that's how I started investing.
Yeah, and you look at fundamentals and you look at technicals. You're basically a mirror image, I would say, of myself. And when we start looking at all this, where do you think we are in this current cycle? It could be uranium, it could be other commodities, whichever commodity you want to talk about. But where do you think we are in the current cycle, and why?
I think we're at the very beginning. I think we're at the very beginning. Like it's just started. I think, obviously, back into 2020 probably is when it started. So 2020 March, after the Fed announced the QE program, and that's when I played my silver game back then. So when they announced QE Infinity, I was like, this is it. I've got to get all the silver I can. So played pretty risky game, getting triple silver ETF, and that paid pretty well. But I mean, that was, I think, the point in which you see the various ratios, coming in favor of commodities, and the last, we've talked about interest rates, and the last hike, I think, is where it's really kicked off. So if you look at the 1970 cycle, when, obviously high inflation, high, rising interest rate environment is when the commodity boom happened. Same in 2000s as well. So when the interest rates started rising is when commodities, the rotation of money really happened. So I think that's where we're at. I think we're at the right at the beginning. We probably second, third inning, as a lot of them say.
So you think we're at the beginning because we're just starting to raise interest rates? Is that kind of what you're basing it off?
No. Based on, but I would look at the flow of money. So flow of money is what I take the most important. So I think you've got to see the flow of money, look at the ratios, and if you look at the ratios, gold to Dow ratios, or uranium to Dow ratios, or obviously you've got. Can I show you my presentation?
Yeah, go ahead and show it.
Just real quickly. All right, so by the way, no financial advice. Just wanted to make sure that's clear.
Yep, just an opinion.
This is just an opinion. But this is effectively the big picture, right? So you've got general equities, which is huge. So you've got really, you've got more than this, obviously. But when I see it, and just for demonstration purposes, this is what you can kind of see. So the bigger picture is basically that you've got general equities, which are worth, 100 trillion just for the US, 100 trillion for worldwide. You've got real estate, residential market in the US, which is worth $70 trillion. And then you've got the bonds, which is approximately 46 trillion in the US. So these are huge, huge, huge markets, right? And so when the money starts rotating into commodities, and commodities are a very small market, so this is probably not an accurate depiction. It's more like you're trying to get a swimming pool and put all the water that's in these swimming pools into a cup, is how I see it. When you look at commodities and when you compare against the bond market and general equities, that's what I kind of feel. So, commodities, your gold is, you're looking at 10 trillion. That's probably all the gold that's ever been mined. So that's not, something that you can all invest in either. And you've got uranium, which is less than $50 billion right now. So you're talking about really small markets. And when the rotation happens, it's not necessarily, I don't really think there's a specific trigger, because obviously the histories were different. Just because you raise interest rates, it doesn't necessarily mean the money will automatically start rotating into commodities, because the commodities might be in a cycle where, or obviously commodity cycle, another thing that's really important is the mining cycle. So if the mining cycle and the monetary policy isn't lining up, then you can't really expect the rotation. So the best way to see, for me anyway, the rotation of money is just charts, ratios, exactly what you do, Andy. So, you've got down to gold ratio here, you've got flattening out, you've got almost like a double bottom happening, and you can see that it's coming up. And that's what I like to see. Oil to Dow ratio. So same thing. So you've got, back in the 1925, you've got flat bottom going on for ages and ages and ages. And then you see those change in flow of money. So you see the money rotating from Dow Jones into oil, general equities into oil, and you see the rounding bottom. So that's exactly what I want to see when I want to see rotation of money and a clear sign of rotation of money. Did that answer your question, Andy?
Yeah, well, no, that's great. That's great, because that's exactly what I look for, is the changing of ratios And when the ratios start to change, I go, ooh, that's starting to gain value against that other asset. And that's what you want to be
Yes,
invested in. So
exactly right.
what else did you learn about the previous bull market, the commodity bull market? I mean, obviously it says be right, sit tight, look at the
Yeah.
valuations, buy low, sell high, obviously all that stuff. But is there anything else that you learned? Like maybe perhaps what sectors do you think are going to perform the best? What are some things that you've learned that last commodity bull market that
Well,
you're
the biggest
applying?
thing that I've learned, yeah, is that commodity bull markets are epic once again. So as you can see in these ratios, you've got like gold to Dow ratio, for example, coming down for years and years and years. So this is 1898. Effectively, you've been in a downtrend the whole time from 1900 to 1970. Like if you look at it as a big trend, but then when it comes up, it's rapid.
Mhm.
It's absolutely rapid. And the reason for that is this, like you've got all the huge funds, in general equities, real estate and bonds coming into this really small, tiny market. And so what happens then is obviously your returns, like you say with general equities, for example, you say you take the stairs up and an elevator down. But with commodities, I feel like you take the stairs down and an elevator up.
I think it's an
Yeah,
ejection seat up.
that's right. Look at this. All to Dow Jones ratio. So you've got slow decline, and then once it rockets, it absolutely rockets. It doesn't take many years for it to go up to its previous, ratio highs. So I think that's really important to just understand when you're investing in commodities.
Is that what draws you to commodities? Because that's what draws me to commodities is the size of the
100%.
move. Because
Yes.
last bull market, when I was watching it, I was watching natural gas and some of the small natural gas companies, and they were going up like day after day, like 3 to 10%. It was like boom, 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 boom. And I'm like,
Yes.
how, like, I didn't know what to do because I was new. And I was
Yep.
looking at it like, this is crazy. Maybe I should buy it. Maybe I shouldn't. I don't know what to do.
Exactly right. Exactly
And
right. Exactly
yeah.
right.
And then from bottom to top, some of them went up 50x, 100x in natural gas. So that's why I'm a
Yeah.
natural gas bull, because I saw that.
Yeah. That's
Um,
exactly right.
so what else do you have in the presentation? I know you were sharing, I think, some uranium stuff
Yeah.
that you've got and overall other ratios.
Yeah, so I think you've asked the question, where are we in the bull market? But
Mhm.
these ratios, basically show us that we're very early stage. Well, we're in a very early stage within the bull market. And you've got Uranium and Dow Jones ratio. And if you think ratios don't work, look at how perfect this parallel channel is, right? Coming down. And it's just broken out, right? So,
Mhm.
and with Chemical to Dow Jones ratio, you've got this perfect looking double bottom right now. It doesn't get any better than this, Andy. And you know what typically happens when you put in a double bottom? It doesn't typically stop here. I mean, I think my least expectation is that it will come up to these levels, but you know what happens with double bottom patterns. They go way beyond. So that's kind of what I'm expecting with these ratios. Yeah. And another thing that I've kind of learned over the years with the commodity cycle is that it's always the energy sector, it's always the base metals and the energies that run first, and then it's the precious metals. So I'm a bit of a precious metals nut because that's what really got me into the commodities in the 2000s, and I've kind of fallen in love with the precious metals. But if you kind of put an objective lens on this, it's always been the oil. So if you look at the oil to gold ratio, for example, this is the 1970s commodity cycle. So if you look at this, you can clearly see that oil has risen first, right? This is a relative strength in oil performance compared to gold. And then towards the end of the commodity cycle is the gold that outperforms. Same here in the 2000s, it's oil that performs first, and then you see the gold performing later. And that's where I think exactly the same thing will pan out this cycle. We've got energy crisis written all over, front of newspapers and things like that. So we've got this. I think this is a potential path that we're headed towards because we're seeing oil prices rise rapidly. I think we're going to see uranium catch up rapidly. And then after all this is done, I think precious metals will, put in the finale for the commodity cycle this time around.
I completely agree. And the way that I've always viewed it, just, given my opinion, is we get inflation into the system, and oil's the transmitter of inflation to everything. That's kind of the way that I've always viewed it.
Yes.
So I know that you got more in the presentation. What else do you have in the presentation there that you'd like to share?
Yeah. So so this is uranium. So uranium, just to reiterate that point, just on the energy running fast. In 1970s, for example, uranium peaked in 1976, and then approximately 3 to 4 years later, gold peaked, and then same in the 2000s. Uranium peaked in 2007, approximately 3 to 4 years later. 2011 peak for gold and silver. So I think the history just repeats. I don't expect anything different this time around.
So when you're looking at that last one there, are you planning to play the uranium market and then rotate your winnings or profits into the physical precious metals or mining companies or something?
Yes,
That's what
definitely. I plan to take. So I think we've talked about this briefly as well, but I think there will be a deflationary pressure within the next couple of years. I don't expect any deflationary pressure anytime soon, but 2 to 3 years down the road, or maybe a little bit longer, or maybe a little bit shorter, I think we'll see a huge deflationary pressure. I want to be out. I want to be holding fiat during that time. And then when we do kind of get a sign that Fed is going to, adopt a loose monetary policy again, that's when I'll go all in on precious metals. I think silver is going to be my greatest play after uranium bulls over, and then after we've had that deflationary pressure, and after Fed signals reverse of course, basically back to loose monetary policy. So that's what I'm thinking.
So you're playing the liquidity. You're playing the liquidity in the system. That I agree with that too, because that's what I've seen. What about, do you think the commodity bull market can continue after we have a deflationary shock? Or do you think that deflationary shock won't happen, where we have imbalances in the system, things become unaffordable, and we just hit like a ceiling or a cap? Like in housing.
I think we can continue. So if you look at the 2000s charts, for example, so we've had the deflation pressure in 2008, but if you look at most of the commodities like oil, copper, iron ore, and things like that, they do come up to some extent. So copper, I think, just equaled this previous 2006, 2007 high in 2008 or something like that. But I might get to this later, but I think we're in a commodity super cycle. So I think 2000s was a mini cycle, if you want to call it that. I don't think it was the main cycle that, something like we've seen in the 1970s. You didn't see all the ratios come down to its 1970s lows or highs, if you want to call them that. But this time around, you've got the inflationary pressure. You've got the huge mining cycle that's behind you with shortages of, commodities everywhere. And you're not just talking about energy, you're talking about battery metal, you're talking about copper, you're talking about aluminium, everything. And I think we've got the ingredients for a super cycle and more. You've got geopolitical tensions. You've just got everything lined up for commodities this time around, which makes me think, unlike the 2000 cycle, yes, we could have that deflationary pressure, but that might not be the end of the commodity cycle. I think we can go far higher after a deflationary pressure is done, until the supply and demand is equalized to some extent.
Okay, and that makes sense. It agrees with kind of what I think too.
Awesome.
All right, so what else do you have on the presentation you'd like to share? Because I know you've got some really good stuff.
So this is uranium to gold ratio, and as you can see, once again, perfect pattern. This is as clean as pattern gets. And so, on a ratio like this, it's just breaking out. It's just started. The uranium bull, if you measure against real money, that's been money for 5,000 years and more. It's just breaking out. So uranium bull has hardly started, in my opinion. And so, I briefly touched on the mining cycle, but this is really a must listen for any commodities investor in mining stocks. I think it's such a great video. I think it's a YouTube video published by Mining Stock Education. But effectively what it is commodities are not like instant coffee. So let's let's just say that I've got this pop-up store and I had to meet huge demand for new customers, right? If I had instant coffees, I could just pour like instant coffees and just into cup and just pour hot water and be done, right? That's easy. And you're very flexible in terms of meeting that demand. But the demand is not so, or your ability to meet that demand is not the same anymore. If you've got if the customers are now asking for proper espresso, right? You've got to acquire new coffee machines. It takes time to grind the beans and put it in and actually extract the coffee. So that slows. But mining, if you're talking about the mining companies, it's right at the end of the other spectrum, which is it takes years and years and years and years for them to first of all, start exploring, start getting the capital in, from whether it be through equity raise or whatever it might be. Then you start exploring, then you make discovery, and then you've got to determine the resources, and then you've got to do pre-feasibility studies. You've got to do another definitive feasibility studies, and then you've got to get funding to kick that off, kick the production off. You've got to get the permitting and the licensing. And then it's years and years and years until that demand is met. So, that's effectively it. So, when no one wants commodities, absolutely no one wants commodities, right? Because all the mining companies go bankrupt. If you look at the last uranium cycle, for example, you won't see most of the names in the current list, right? Current lineup. So basically the mining companies go bankrupt. When the prices get ridiculously high, everyone jumps in. And then, 5 years down the road, 6 years down the road, when everyone's trying to make money off this, high commodity prices, the supply is immense. And then that drops the price down. So effectively, the mining cycle is it just happens over and over and over again. And it's just so predictable, because it's happened so consistently over time. It's just so predictable. You know exactly what's going to happen. And I don't know about general equities. The reason why I don't really like general equities as much is it's not as predictable. Like, I mean, in hindsight, it's easy to say, I should have been in Tesla, or I should have been in Apple, or whatever it might be, but you don't know where it's going to go. Did anyone know that back in maybe I'm just not smart enough, but back in the 1980s, you've had the Nikkei bubble. Back in 1990s to 2000, you've had the dot-com bubble, for example. Like, I mean, how do you know that these bubbles are going to happen in certain places of the market? You don't know which country it's going to be. You don't know which sector it's going to be. It's all about money flow. And obviously, it's a lot harder to predict where the money is going to flow in the general equities. Whereas in commodities, it just happens over and over again. And, everyone's heard of the term, rising tide lifts all boats. It's exactly the case in commodities. So you can pretty much throw a dart, and you'll come out a winner. Obviously, there are smarter ways to play that, but yeah, effectively, commodity cycle that's what's so great about the commodity cycle.
And you talked about the cycle and getting capital and pre-feasibility studies and all that stuff. Which of the commodities, which commodities do you think have the toughest time to get into production, or takes the longest time that you've seen? What sectors?
Yeah, I'm not an expert on that, but everyone in the uranium space is saying that it is uranium, and it makes sense because of the nature of the commodity. It is very energy dense and potentially dangerous. Uranium is what I'm hearing, so I would say uranium.
Yeah, I would agree. It's the hardest to get into production, I think. Yep.
Yeah.
So
if you have sorry, go ahead, Andy.
I was gonna say, what do you have here? I see mega uranium.
Yeah, mega uranium. So to demonstrate, I guess the cycles of the mining cycle. Mining stock education actually uses uranium stocks to demonstrate this, just because it is exaggerated. The moves are very much exaggerated with the uranium stocks, which is what I like so much about the uranium stocks. So you've got mega uranium here. The gains can be crazy. It can blow all expectations out of water. And you've got here, it says U3O8 went up by 475%, but then the leverage that you might get out of a small explorer is 10 times that. It gained 10 times the increase of spot price in uranium. And yeah, it gives you 120 times in 16 months. You know, these are the type of, I mean, I don't think I really expect these type of gains in as much as I like it, but these are the type of gains you can get potentially from a small explorer within a very short period. Could be life-changing.
What's crazy is 120x in 16 months. I don't think we can see that in general equities anywhere. Only in a gigantic commodity bull market. And if uranium goes to some ridiculous level, say we have an energy crisis, and say that we have shortages of minerals where we can't build things, they start to recommission nuclear power plants or extend the nuclear power plants, and we can't get the production back online like you were saying.
Yeah.
Could easily happen again.
That's right. Yeah, it's very exciting stuff, Andy. So yeah, and basically what that's resulted in is everyone talks about supply deficit, but if you look at the 2020 number, we're only really supplying 74% of the world's demand. And so yeah, I mean, and you know what's happening with spot, you know, they pretty much this year, I think they've been acquiring at 1 million pounds per week or something like that. And everyone talks about how they don't want to annualize it, but I'm going to annualize it. That's 52 million pounds of uranium, and world demand is 200 million pounds. So that's a huge chunk of the world's demand right now. And you know, I don't know. Who knows when the secondary supply will dry out? But I think it's going to dry out soon, from what I've been reading on, you know, what I've been hearing from very smart people on Twitter. And you know, once they go dry, I think we might have a massive parabolic move like you've never seen before.
Oh, so you're going to my area where I think it's going to go bigger than the majority of others. So here's a question. Since you've been looking at all this, you've been obviously looking at the data. How do you play it? Like what do you think's the best way to play it? Do you just buy the physical, you know, spot? Do you buy mining companies? Like how do you play this?
I buy the mining companies. So the way that I positioned, so I'll skip through all this. Okay. I'll skip through this, but this is a bit that's probably relevant. But if you look at any commodity cycle, it always starts off with the bigger miners. So you've got all your blue chips like Chemico and Kazatomprom and Paladin and things like that, which starts the bull, right? So at the very beginning of the bull market, it's very typical, like even in precious metals, I've seen it firsthand when I was investing in them in 2000s. You see all the majors running and you kind of start wondering, okay, is my Explorer ever going to catch up? Why is it not rising when the whole use sector seems to be quite bullish? And so that's quite normal, I think, from what I've seen so far anyway. So you've got here, this is the 2004 chart. It goes from 2004 to 2007 when the bulk of the run happened. And this is Chemico versus Mega Uranium. And you know Mega Uranium massively outperformed in this bull market. But what you'll see is in the beginning part of the bull market, CCJ massively outperformed Mega Uranium. And that's very normal.
The top one is the ratio of CCJ to Mega Uranium.
It's the ratio. Yes, that's right. This is the CCJ divided by Mega Uranium. And so you've got the main players within the sector outperforming as institutional. I would say it's the institutional investors and the smart money positioning themselves in preparation for the bull run. And so that's why you see, you know, any stock that offers a little bit of liquidity, a little bit of, I guess, size, that's where they jump into first. They position themselves, and then you see the outperformance. But then towards the end of the bull run, so from 2004 here or I think this is December 2004 to 2007, you can see that Mega Uranium massively outperformed CCJ. So I think I've been talking about for a while on my Twitter where we think are in the uranium space. I think we're around here. Like this is where they started raising rates. I think it was 30th of June 2004. So yeah, if you imagine this is where we are, I think, about to see a takeover by the explorers and the smaller caps in terms of performance. And so far in the bull market, when I first started investing, I positioned myself with the bigger names. So even on the Australian Stock Exchange, for example, like DYL, Boss Energy, Bannerman, and things like that, Paladin. But I've recently, through this pullback, during this pullback, I repositioned and rebalanced a lot of my portfolio into smaller, more junior plays, because I do expect major outperformance by the explorers in the, I mean, maybe not immediately, but this is what I'm willing to get out, basically.
Mm-hmm.
This is how I'm playing it.
So the one of the questions I have, we have three types. We've got producers, we've got developers, yes, and then we've got explorers. When you say, and maybe or maybe not, this question, do you think that the developers and the explorers are going to take off now, or are you just saying the explorers themselves and not necessarily the developers? Or we don't necessarily know. It could be either or.
So developers are solid performers all the way throughout the bull market. So usually what I see with the developers, they do pretty well all the way throughout. The only thing with the developers though is that, that typical life cycle of the miner, I think you've just got to be careful where you get in within that life cycle. So if they are stuck within that valley where they are seeking funding, but they are unsuccessful, it can really hamper the price of the shares. So if you know that they're gonna, if you can even get a glimpse of them getting funding, or close to getting funding, it might be a good place to start. But the only trouble with developers for me is that, yeah, if they fail to get funding, it really drags the share prices down. I mean, I didn't expect that, given that uranium bull market will be so strong, that I think there will be a lot of interest in the space in terms of investment, but that could be a potential issue. But yeah, developers normally, the mid caps, if you want to call them that, like the Bannermans and deep yellows and things like that, I think there will be solid performers all the way throughout. And then they might even outperform the next leg up in terms of against explorers. But I do believe that from 6 months now, or I think this leg up will probably last 6 months to 12 months, in my opinion. And then when we have that, the leg up after that, I think that's when the explorers will massively outperform.
Okay, and here's another question. I know it's somewhat related, but not related. As you were kind of going through this, how did you get from where version 1, Scott, of the first commodity bull market to version 2 or 3 of where you are today? How did you make that journey? Like, what was the learning process? What did you dive into? Like, how did you get to where you're at?
I think it was the mistake. So, when as I said, first time around, from 2004 to 2007 and 8, I made a mistake of just trading out too frequently and not just positioning myself, not understanding the cycle. And then I've just observed, like, it was just so real to me at the time, from 2008 to 2011, when I saw the precious metals cycle. I mean, I've had the reason why this is so clear to me now is, like, I remember living through the moments where silver went up from 35 to 50, and like the bigger miners didn't move at all. They didn't budge. And silver could be up like 5% and the bigger miners would be down 3%. I was like, what is going on? And I thought, okay, this is like really good time to buy, because now like your miners are being undervalued. But that wasn't the case. That was the smart money getting out. So I think what happens at the end, towards the end of the bull cycle, is, all the smart money that positioned early and drove that outperformance, the major miners, they sell out early as well. So from here, like 2006, if you look at that, the biggest run in uranium came between 2006 and 7. But CCJ, I think, went up 25% or something. That smart money selling against the crowd and going, thank you very much, I'll sell against that rising spot price, I'll take my profit here, thank you. So that's really a critical learning experience for me. And one of my exit strategies is to really observe the big miners and look at how they are performing against the spot market. And I think that will really give me a good indication when to exit. I'm not going to be naive enough to say it's a better value now, because bigger miners hasn't risen so much against the spot prices. What I was saying instead is smart money is getting out. This is a
Yep.
sign that smart money is starting to get out and take profits. So that's a big learning. So sit tight is the first one. You've just got to sit tight, not try to trade in and out. And second is look for signs of bigger money exiting the sector to time your own exits.
So basically, you're taking an experience-based approach, and then you try tiding all the cycles to it afterwards,
Yes.
so to speak, to understand why it did that. That's
Yes,
I mean, because
exactly right.
that's what I did too, for the most part.
Yes.
Okay, so we're early in the cycle. We should see larger cap outperform the explorers for a period of time, which we kind of already saw that. And now
Yep.
we're coming to, we'll call it beginning to mid cycle, where it's transitioning from a beginning to the mid, or wherever that is. We should see a vast
Yep.
outperformance of the developers and the explorers. And you're going to position, like, what explorers do you really like to position for this? Like, if you're willing to share, like which ones do you like it, and why do you like them?
Yeah, sure. Not financial advice once again, but
Yep.
my favorite explorer has to be baseload. And the reason for that is with explorers, one thing that, obviously I've had many failed investments in explorers as well, but one thing that I've learned to do is just bet on the winners, right? If you bet on the winners, they will keep striking. The strikers keep striking, the losers never strike. So,
Okay.
I'm not knocking down any shares, but, for example, you've had like Standard Uranium, for example, last year have an 8,000 meter drilling program without any significant intercepts. And that's very telling. I think not just on the company itself, but the management team, the geo team, and so on. So if I can pick a combination, so baseload has already proved, for example, that they've hit high uranium over 1%. They've intercepted 22,000 CPS in the recent drilling program, and they've got, I think that was just based on 2,000 out of 10,000 they had planned for the winter drilling program. They've just announced that they're going to extend that to 50, or they've got permits to drill 50,000 meters, which is crazy. They've got Sykes also, obviously. Top management. He's the guy who found the Next Gen's area deposit, the Denison Mines Willer deposit, and also the Rough Rider, Heather's Rough Rider. And yeah, they've just got everything lined up. And the biggest trigger for explorers in terms of price, if you look at Next Gen's chart, for example, going back to the 2000s, for example, even during the bear market, the biggest trigger in terms of share price is when they release resource estimate for the first time. It creates all the hype, and it's not just for uranium; it's for any sector. Like when an explorer first announces their and Bannerman did that, I think, during 2007 when they did 40x within 12 months or something like that. 2007, that's what triggered it. So if an explorer can put out a resource estimate during this bull market, I think that explorer will be the winner in the cycle. And baseload, James Sykes keeps saying he's aiming to put out a resource estimate, JORC compliant resource estimate by the end of this year. And that's hugely exciting. And not just that, they've got 92E, which is my second favorite explorer, 450 meters from baseload's Ekio. It's the GMZ discovery that they made at 92E, which indicates that 450 meters up north of baseload, which indicates that there might be a huge system of mineralization. So that's really what gets me excited, because we've got drills this time around where they've crossed quite a bit of length across. They've got probably possibly a continuity up to 92E's discovery hole. And so I think all the stars are lining up for me on baseload.
Okay, so to take a key takeaway, I think here is when an exploration company, because we're looking at exploration companies that are going to outperform here shortly, when they stick a drill in and they actually hit something, that isn't necessarily when they take off. They may take off some, and a good strategy perhaps might be to find exploration companies that hit something but haven't defined what the resource is. Is that a fair statement?
Yes. Yes, I would
And
say so. I would say so. And I think you need the aggressiveness because obviously you need to drill enough holes to come up with your resource estimate. So you want an aggressive team because I don't think this bull market it will last very long. The uranium bull market. I don't think it's going to go on for years and years and years. So I think if you want to catch this bull cycle and put out a resource estimate within before the end of this bull cycle, I think the management team needs to be aggressive in drilling. And putting out that resource estimate. So baseload has that.
Okay, so you're saying it has the characteristics. It's poked the hole, it found something, and it's being aggressive, so it can put out a resource estimate during this bull market. And what makes you think that the current bull market's not going to be long lasting? What makes you think that? Is it liquidity? Is you think there's just going to be a bunch of money coming in and flowing back out? Like what makes you think it's not going to last that long?
Just based on history. So if you look at the past uranium cycles, it always just peaked out and then just came down, tumbling down. So I think what will happen is it will overshoot. I think it will overshoot massively. So it will create, so obviously there's true valuation where uranium should be, but then because of the overshoot, it's not because of the fundamentals are worsening or anything like that. I think the fundamentals for uranium might be there for years and years and years. But when it gets way above its fair value, and when profit takers start taking profits, like I'm not planning to hold on for this forever. Like if it gives me good enough profit, I'm taking my profit. So when the profit takers start piling in and start dumping their shares, that's what will drive, I think, rather than the fundamentals, I think that's what will drive the share prices and the price of uranium. And it's same with spot, for example. So when institutional investors, for example, I know they've got now like, potentially like ESG funds, for example, lining up to get some action in uranium. When they are happy with their profits, I think they're going to start taking those profits. And yeah, the fundamentals might still be there, but if they're profit takers and just purely based on the price action, people might start dumping. And I think that's what's going to happen with any parabolic moves, whether it be Tulip or Dogecoin or whatever it might be. With any parabolic moves, there's an ugly end to it. So that's what I'm expecting for this uranium bull.
And you were talking about maybe a potential massive squeeze. Like how? Yeah. I know what you had previously, and you talked to me, and we were looking at certain things. Like, what realistically, what is a range that we could expect? Like if you're conservative, what would you say? And if you were going just total crazy, what does crazy look like too?
Okay. So this is something that I put out on my Twitter not too long ago. But yeah, I mean, this is effectively your Dow Jones to oil ratio. And the reason why I posted this is because, funnily enough, your uranium prices always match your peak uranium price always match the peak oil price. So basically in the 1970s, for example, you had peak uranium price per pound of $40 during this peak, and you had peak oil price per barrel of around $40 per barrel. So it matched one for one. Not the same time, but during this era of commodity cycle, it matched. So if you look at the 2000 cycle as well, and this is why I said it's a mini cycle, because energy crisis, energy crisis, energy crisis, and that's where I think we're headed, right down below here.
Okay, but, so when you look at the bottom, what years were those energy crisis bottoms?
So this is around 1920. This is around 1920. And okay. I believe there was a huge fear of running out before the US made major discoveries in oil. There was a huge fear that US was going to run out of oil.
So 1920, and then that was 1970 to 80, right?
78 or something like that. Yes.
Yep.
So yeah, so I believe if you look at these charts, and what's very telling, actually, glad that you mentioned it, it's the rate at which this ratio is coming down. So if you look at this, like it's come down, like it's just dropped. Like you don't see that in the mini cycles. You don't really see that. You see a little squiggle down. Like here, you see a squiggle down. It's like an orderly fashion move. But if you look at this, when there was a super cycle, it's a dramatic drop down. It's just a stone dropping, right? Falling off the sky. But if you look at this, it's dropping. It's a stone drop. It's a stone drop. I think that's what's very, very telling about this cycle. And that's what makes me believe even more that this will be a super cycle rather than your mini cycle that you've seen here and here.
So it's the way that it's dropping and the way it's performing is performing exactly like super cycles before.
Yep.
And
Yes.
I see some numbers over there that look pretty crazy.
Yeah.
You're starting to sound like me.
Yeah. So if you just assume that this is going to be a mini cycle, the ratio that I'm expecting against Dow, like your oil price against Dow is probably around 80. So this line where you see a lot of like resistance and support, around 80 to 1. So Dow Jones is probably sitting at like 33,000 from memory. And and based on that, you get $412 per barrel of oil if it's a mini cycle, But if it is a super cycle, like I think it is, and you can actually draw even even more crazy line through this and say, actually, this is a broadening type of
Wedge.
move.
You've got a broadening
I'm not going to do
wedge.
that. Yes. Yeah, I'm not going to do that. Let's just take this level and just say 20 to 1, and you get to 1,650 per barrel. So if you say, okay, well, uranium per pound met 1 to 1 for oil per barrel in the last 2 cycles, I think it's quite reasonable to expect the same this cycle, if not more, because obviously uranium is relatively new source of energy than oil. So you've got a lot more growth in nuclear reactors as when you compare it, the rate of growth in the nuclear power generation is higher than oil. So, I think it's very reasonable to assume that it's going to repeat and say, come down to the price of oil this cycle. So assuming it's a mini cycle, $412 per barrel, assuming it's a mega cycle or super cycle, $16.50 per barrel, which means $16.50 per pound of uranium.
Now, here's a question. When you did those calculations in the ratio, did you use the current Dow Jones Industrial Average price, or
Yes.
do you?
Yep.
So those calculations could come down depending on the Dow Jones if that were to come down. So if the Dow Jones came down, 50%, that means that number would come down 50%.
Yes, that's
Okay.
right.
I'm just wanted to make sure, because the numbers seem extreme when people look at it. Well, there's no way, but the Dow Jones could come down at the same time that ratio compresses. So they are two moving numbers. It's very dynamic.
Yes.
Yeah. Yeah, that's well, one thing is I like that you recognize the broadening wedge, because when I looked at that, I was like, well, what if we did this, because it's a broadening wedge, and what if that blows out, and hits the wedge?
That's right.
It's crazy to even think about this. And nice observation. Even I didn't even really think about the way that the markets move like that, like a stone dropping. That was a really good observation there, honestly.
Thank you.
Mm-hmm.
Thanks, Andy. So this I would say is the high case for me. And I've done all sorts of calculations. So if you if you measure uranium, price of uranium, real money, and if you look at 1976, for example, the ratio was between 2.5 and 3.5. If you look at 2007, the ratio was around 4.8 to 1. So this is the range that it gives you. So I've just done a reverse calculation. If you measure uranium in Dow and just assume that gold is going to get to 3,000, I think, which is pretty conservative. I'm a pretty big, gold bull as well. I think this is a pretty conservative estimate for 2024. You get 625 to 1,200 per pound uranium price. So this, I think, is sorry.
So the way that I always view that, because I do the same thing, gold is just an inflation index. So you're comparing something to an inflation adjusted number. Is that how you view it too, or?
Yeah,
definitely.
Yeah, gold is money. Gold is money. When you measure stuff against the US dollar, you're just measuring stuff in fiat currency. So it's kind of meaningless.
So you're taking an inflation. It's basically an inflation adjusted number.
That's right.
Yep.
And if you just take, this is the lowest number I could get to in terms of uranium. Like, this is the lowest case. I don't know how else it can go lower than this, but if you just take the percentage gains in the 2000s, and once again, I'd like to just remind that I don't think this is the same cycle as the 2000s. I think 2000s was a mini cycle, and I think this is a super cycle. So if you just take the gains, the percentage gains in the 2000s of uranium, it started off at 7, went up to 140. That's about 20x gain. And if you take the low of 2016 of $17 and multiply it by 20, you get to 340. So for me, this is the low case.
Look at that. I love it. I love it because a lot of people, oh, it's $200. That's where we're going to go. I'm going to sell out at 200. And I'm like, I can't even get, if we hit 200, what that means is that that person thinks that this is like the worst bull market that we'll ever see.
Yeah.
To go from
That's
that.
Right.
So I think that the conditions are far different than any bull market that we've seen, given the energy crisis in natural gas, coal, and what we've seen in those areas. I expect 100%. No reason to be different in uranium.
And well, there's definitely no case for it being worse than the previous bull markets, is my opinion. And you've got ESG. I think that's a huge part of this story as well. Like, like people who these large institutional funds that want to invest in energy can't invest in, it's hard for them to invest just for ESG reasons. Like it's hard for them to invest in coal, hard for them to invest in oil, and they've got to find something else. And when uranium offers the liquidity that it will offer, I think fairly soon, like the funds will just jump all over this.
Well, here's a scenario that I've always thought, right? Like this is what I think. And then tell me if you resonate or maybe some derivative of it. When things start to get moving, I think we're just going to see a massive pile on of like Reddit people, millennials piling in. I call it the bro group. Like it's a bro stock where you've got ESG and all, it lines up with all this. We're just going to see this massive flood come in, and it's going to be like a bottle rocket shooting way up there. And I agree. I don't think it can stay up there, but it could be a massive squeeze.
It could be a massive squeeze. I think it will be a massive squeeze. And you didn't have spot, like back in the 2007 and 2000s bull market, you didn't have spot. You didn't have financial institutions taking a large part of this. And now you've got spot. I think it's a huge difference. I think it's a huge difference. I mean, look at how much, uranium they are taking off market and absolutely, drying it up. So I think it's a huge factor in this bull run.
There's also the inelasticity of demand from the power plants too, the nuclear, where they could afford a lot and all be fighting for it, where they can't shut these things down. Exactly. So that's also absolutely crazy.
And so this is the calculation that I've done. So not including your obviously your infrastructure costs and everything like that, your the cost of building power plants. I mean, once you've got those power plants in place, the cost of commodity to fuel the power plant and to produce electricity is minuscule. Like it's so small that it's not even funny. So right now at current prices, like uranium is like 700 times cheaper in commodity to produce the gigajoule of energy. Oil costs like $20. I mean, this math might be wrong. I've just done a rough math calculation myself. But your uranium is 3 cents per gigajoule of power. I mean, if you visualize this, like, I don't know, obviously this will be like enriched or whatever, but I don't know. It just doesn't make any sense. It's so cheap. Yes, the inelasticity of demand it is another thing. I mean, the fuel buyers wouldn't care at all if uranium prices jumped up to 500 per pound. I don't think it would hit their bottom line at all. So that's what's so crazy about this.
Well, here's the thing though. We could get into a situation where electricity prices get very expensive, like Europe already has, and it starts to permeate through the entire world, where natural gas becomes basically in a shortage. And they'll say, well, we already have the nuclear power plants built. They're already put in place. Just extend it. Just go get the fuel.
Yeah.
And then everyone's going to be rushing to get uranium fuel all at the same time. And I just look at this like, oh my goodness.
Yeah, definitely. And look at this. This is, I think, I mean, obviously there's a lot of stuff on Twitter around China and how they plan to build 150 nuclear reactors over the next 10 years or something like that, or 15 years. But it's huge. Like if you look at nuclear power generation, I think I've done a very quick math, and if they did build another 150 nuclear reactors, I think they need another 60 million pounds of uranium per year, something like that. That's my rough calculation. I don't know if it's right or not, but just around that ballpark. Imagine that, like we're already short like 70 million pounds of uranium per year or something like that, 60 million pounds. And China, they're not going to just sit around. I mean, they already, got into that agreement with Kazatomprom to build a warehouse with them. I mean, they are thinking about stacking it up already. They're not going to wait until all those nuclear reactors are built. They want to secure some commodity like uranium before they build all their nuclear reactors. And you can see here, this is the United States, but China is becoming a major player in the nuclear power generation story. Like they're equaling France. France, I think, generates, half of their electricity or more than that from nuclear, maybe not more.
I thought it was a very high percentage.
This is France. Yeah, it's a high percentage. So 40,000, or I don't know how you read that, 40,750 kilowatt per hour. And then this is per capita, by the way. And yeah, around, what is that?
It's a little less than half. 40.
Yeah, little less than half. Yeah, that's right. Yep. I mean, China is becoming a major story. Like, look at that growth projection. It's massive. And China is the biggest generator of electricity in the world. And what's so crazy about this, there was a chart here. Okay, so China, this is a measure of consumption of electricity per capita,
per
right?
capita.
As you can see, USA is obviously the biggest consumer of electricity per capita. Like China has such a long way to go to hit that mark. I think USA pretty much flattened out around this mark. But before the demand of your consumers are satisfied in terms of their electricity needs, they've got a long way to go.
Another one that's in the middle of their S curve in terms of energy consumption is India. You can see them on the bottom there.
Yeah.
That one's going to explode higher too.
Yeah. Yep. That's got a lot of growth potential, and with the number of populations that we've got, once they start coming out with their nuclear reactor stories, I think there's been a couple. I think there's been a couple of like little stories here and there around India, exploring their nuclear options. But if it becomes mainstream, oh my goodness, it's gonna be insane.
I look at it from the perspective of coal and natural gas as well, because I do a lot of energy S curve looking at all this. India and China are the two big ones that are in the middle of their S curves starting to come up. India just entered it. So it's going to impact absolutely everything: oil, natural gas, coal, and obviously nuclear.
It's just so inevitable. Humans are constantly in need of more energy, right? It's just life.
So what you're doing is, so we know all this, like you obviously have done the technical analysis, you've done the fundamental analysis, we're looking at all this stuff. The way that you've positioned has been more developer and explorer, especially now. Are you just sitting in them? Are you just waiting for this to happen? Is that ultimately what's going on?
Pretty much. I think, and I think this is the time to just sit tight, because I think this is where I drew up, where we think we're in this bull market, right? And it really coincides. So I think you might have talked about this on your channel as well before, that basically if you draw this and if you look at it in a log chart, these squares, like this is like something like 20, they are 3 months apart, basically. This the length of this consolidation, or the rounding pattern, is 3 months apart, and it's literally pretty much the same. And the percentage gain, or the depth here, is pretty much the same. We've had rate hike, first rate hike here at the end of this rounding bottom. We've had first rate hike at the end of this rounding bottom, and it just took off. And what that looks like is, this is where they raised interest rate. This is the yellow line here, basically. And for anyone who's going to try and trade this now, like because they've been burnt by the last consolidation. I'm sure there will be many who will try and, you know, take a little bit of profit, wait for a reaction to come back to the 200 moving average. I think it's just never going to touch it. I think it might just lift off and just never look back at 200 EMA again. So for me, like, nothing will beat a sit tight strategy for me. I'm just going to sit tight, wait for it to pan out for the next, you know, 12 to 18 months, see how it goes. I'll just keep observing, look at the ratios, look at how the bigger miners are performing against the spot prices, and yeah, just sit tight for a long time.
Yeah, what I think is coming is very close to what you think is coming, which is like you're going to get a lift off and you can't get back in. It's like,
yeah,
exactly. You're going to be like trying to throw a baseball at something that's moving away at a very fast rate. And you're like, I can't catch it. So it's like you're in or you're out, because it'll just go. And then you feel like you're chasing. You feel like I shouldn't be doing this, because that's what happened the first bull market with me and natural gas. You'd see these massive up days and you're like, I don't know what to do. Like it was like 8%, 8%, 5%, 3%, 8%. I'm like, oh my God, I can't buy into it because you'd be chasing.
That's right. That's
So
right.
I got caught
exactly
out.
What happened. That's exactly what happened to me in you know, in the 2000s when I first started. And I took like 50% profits. I took like 30% profits. I was like cheering. I was like, oh my goodness, that was such easy money. But then when I looked back at it a couple of years later, I was like, oh my goodness, I missed out on 100x gains. I missed out on 50x gains. I missed out on so many gains. So I'm not going to make that same mistake again. So if you lose your position, I mean, Livermore has to be one of the best traders that's ever lived. And if he's telling you that sitting tight is the only real way to make big money, like, I'm not gonna try and outsmart the guy. I'm definitely not as smart as him. So I'm just gonna sit tight. It's the easiest thing to do.
And speaking of Livermore, you said that a lot of these have that funnel pattern that he always puts on there.
Yeah.
So we're seeing that across a whole bunch of different commodity companies, and generally,
so
not just uranium.
Yeah. That's right.
Is there anything else that you'd like to share with the viewers of maybe whatever it may be in relationship to the commodity market or uranium market that you think is absolutely critical to understand?
I think, just looking back at history and what the valuations might look like, I can probably share that with you just very briefly, because I think when we, you know, people like us throw out numbers, you know, obviously we get comments saying, oh, this is crazy, you're dreaming and so on. But, you know, if you actually study history, we're not dreaming, we're just expecting a repeat of history, which has happened many times in history. So, you know, this is what I mean when I talk about explorers, and this will probably be an eye-opener for some of you, but you know, you've got here, this is a report that was published by Sprott in February 2007, pretty much at the peak of the uranium bubble of the 2000s. And so if you look at Chemico, it was valued, I don't know if you can see that, but it was valued at 8.34, the EV, $8.34 per pound of uranium. That's not that high. But if you look at Denison, $21 per pound. But wait for this. Like, everyone says, how can you expect explorers to be valued higher than Chemico, right? Because Chemico is producing and it's the biggest. How can it possibly? Well, it happens. So if you look at energy, and there are so many examples of this. Like, I've just been going through all the old reports, all the announcements through uranium companies that's been through since, you know, 2000s or whatnot. But what you see is, like, this is Energy Metals, like this is an Australian listed company, EME. They had JUSRC resource of 14.3 million. And this wasn't their peak. So I just wanted to give you an accurate picture of what the market cap was, 176. But I took this price on this date and then just calculated its price, market cap price, at its peak. And it was 320 million market cap. And the dollar value of the dollar value that it was given per pound of uranium, 22.3. That's like, I mean, this is Australian dollars, of course, but it's irrelevant because I think in 2007 we were pretty much on par. So yeah, 22.3 dollars per pound of uranium in the ground, Explorer.
This is
And Bannerman, I can give you so many examples. Like if you look at this, for example, like these guys didn't even have a resource estimate. Look at them, 445. This wasn't their peak either. 445, 416, 358. And Bannerman as well. 519 million market cap, 27 million pounds, $19.2 per pound of uranium in the ground. No plant, no production.
This is crazy because what it does is it throws all of the people's perceptions and what they think is right or known right, where the producers are definitely going to be more expensive than the explorers.
Yeah.
It crinkles that up and throws that out the window. So
exactly.
I mean, what? Okay, I'm gathering my thoughts here because this is so ridiculous. So Bannerman, that was at 2007 high. That's a 19.2 per pound, and they were an explorer. In a percentage term, what is that? Because the spot price got to 140. Is that 145 or 140, somewhere in that range? So if I were to, I'm just going to do a quick calculation here to get an accurate. So let's say spot hits one of those numbers that we said. So Bannerman was priced at 19 divided by 140. It's about 13% of the spot price at that time. Let's say spot price, and I'm just going to throw out a number, it goes to $1,000. That means that some of these explorers could be valued at $135 a pound, given the same ratio that they did the last bull market. And again, the last bull market wasn't a super cycle type movement, perhaps. This could be, which could ultimately drive valuations even worse if the capital flows come in and go all crazy as heck. But let's just say that. So that's $135 per pound. Bannerman has how many pounds in the ground? 240 or 50?
I think 270 or something.
Or 270? Okay. Times 270.
Something like that, yes.
That's a market cap. Did I even... Hold on. I don't know if that's... Hold on. I can't...
It'll give you a crazy number.
I can't... Hold on. I don't think that's right. I'm sorry. 35 billion?
Zillion. Could be. Yeah.
Wait, so what are we at today?
Bannerman? It's like
Bannerman,
300 million right now. 300 million market cap, I think. Somewhere
around there. That's 117 times where it's at today. If their uranium stays at that thing, because you said that they may come out with a new resource estimate, right?
Bannerman, yeah, I think they've got this feed thing going on with Bannerman, so which I think is like resource upgrade programs, similar to what Elevate is doing. So they could very well upgrade their resource estimate. Yes.
This just like blows my mind. And what if, I mean, hypothetically, this is a what if, and I like playing in the what if games every once in a while. I know this isn't projections, guys. Please don't use this as advice or anything. But let's say it's 130 is that 10-13% number that Bannerman hit in 2007. And let's say baseload finds something that's of good size. Let's say they find something like what would be of good size? What do you want to use as an example? 100 million pounds? Or you think it could be bigger? It's
hard to say. It's hard to say, but
let's do 100 million.
Let's say 100 million. That would be pretty good.
And what's their market cap at? I'm at 13 billion for a market cap. Divided by
I think their market
50,
cap's
60,
around 80 million now, or something like that. I don't know. Like, I mean, they did rise quite a bit last week. So,
let's do 80 million, 162x.
Yeah. But all the hype around the explorers could send it higher potentially.
Well, if they find high grade stuff and they put that resource estimate and it's a pretty big deposit. Yeah.
That's right.
Your biggest problem is,
that's the thing with at the Basker. I mean, obviously your African assets are normally shallower, but with at the Basker, you've got much higher grades. I think with Bannerman, I think you're talking about 300 ppm cutoff or something like that. But with these at the Basker, you're talking about thousands in ppm. You're talking about over 1% grade in uranium, potentially a lot higher. So, you know, they could very well get a lot higher premium for their pounds in the ground. So yeah.
That's absolutely, I think I would have said you're insane to think that an explorer would be priced higher than a producer, but that's actually what happened in history. And then if this happens again, one of these explorers who finds something, I mean, it could be life-changing, life-altering. The hardest part there is to hold through the whole thing, because your count, you're gonna like click
100%.
refresh on your account and it's gonna be like adding a zero.
It's gonna be hard. It's gonna be hard. It's gonna be hard.
Wow.
It's gonna be very hard. Yeah, but that's why I keep saying base load could be a life changer for me, because I know obviously there are explorers and maybe others will do better, but I mean, all the stars are lining up in my opinion just on base load, and the returns, yeah, for an explorer could be crazy. And that's why Terry, you know Terry obviously, right? That's why he's all in on explorer. Like he understands the crazy valuation that the explorers get, because with explorers, like, you're not talking about your, you know, smart money or institutional investors who actually do some type of NPV calculations or DCF calculations. You know, you're talking about retail investors piling to chase momentum.
Yes.
And that's what gives it crazy valuations. And with baseload, another beautiful thing about baseload is that it's got a super tight structure, share structure, and only 33% owned by retail. 33% owned by retail. Like, what does that mean? It's so thinly traded.
It
like,
means that
any type of money,
all the money is going to go through this little hole like that.
Oh my goodness.
And the only thing to absorb it is price. That's it.
Exactly. So that's why I like it. I mean, institutional investors, I mean, it shows confidence in the company. The fact that they were able to raise capital, like when they had a lot of cash, means that there are, you know, potentially guys out there who know that stuff, wants to get in now, you know. So, yeah.
So, I mean, thanks for sharing this. This is absolutely gold in terms of, well, maybe I should say it's absolutely uranium in terms of its worth, because there's a lot of stuff that I don't really even think of. Like, I didn't look at the last bull market and do actual valuations at the peak. So obviously a great observation there. I think that's, it's a wonderful observation to have and wonderful knowledge to have before investing in this bull market. And another thing that I completely did not look at, but kind of knew underneath, is when you compare the Dow Jones and how it bounced off that channel, and how we could potentially be going into a super cycle. I always thought we were going into a commodity super cycle. I just looked at it from a different perspective versus then looking at the ratio and doing that. That's a pretty genius way to look at it, in my opinion. So, but there was something else you wanted to share as well, that you wanted to share with everybody. Maybe it was at like the end of the presentation or something.
Oh, yes.
Yep.
Yes. No. Yeah. I'm a Christian myself, so just wanted to share the gospel just very quickly. And I don't know. Like, I mean, I've made money, I've lost money, you know, through investing, and the only time I've just been truly content is when I was one with Jesus Christ, and as you know, when I recognize Him as my Savior and Lord. So yeah, I just wanted to quickly share John 3:16 with you. So I think, you know, maybe some of you have come across this, but you know, if you haven't, yeah, maybe just take a moment to to read this. So it basically says it's the good news that the Bible tells, and I think it really captures the essence of it, which is, you know, God loved us so much. So for God so loved the world that He gave His one and only Son, Jesus Christ, that whoever believes in Him. So He doesn't discriminate. It says whoever. It means anyone who believes in Him shall not perish, but have eternal life. So yeah, I just wanted to share that.
That's great, John.
Thank you for giving me the opportunity.
That's great. So, I'd love to have you back on, Scott. This was an incredible conversation. I think you have a ton of, this is huge value even to myself. And that's one of the reasons why I reached out to you and wanted to talk to you just in general about overall investing and bouncing ideas off you, and even in other sectors. So, so the way that people reach you, if they want to follow some of your information, is at U_AG_ on Twitter. I also
That's
follow
right.
Scott on Twitter myself. Hopefully you'll come back on whenever you get the chance or whenever you want to discuss maybe perhaps other commodities, ones that I've put in front of you that have blown you away.
Yes,
And
yes.
we
Can't
can
get in
chat.
sleep after we talked about it.
All right,
Yes.
Scott. So I appreciate you being on the channel. I definitely would love to have you back. And
Thank you,
we'll see
Andy.
you
Really
next time.
appreciate it. Awesome. Thank you, Andy.
Yep. Bye.